All right, no one's fallen asleep yet. Nice. We're going to go ahead and get on to taxation. All right, so a lot of times I get to talking about different types of accounts and kind of speed through some things. So we're going to take just a moment to talk about the different types of accounts that are out there so that we can then discuss how that affects total taxation. So we've talked about IRA, 401k, SEP, Simple, KEO, all those types of plans are essentially tax deferred. So they're going to work the same way. So you're not going to pay tax when you earn it. You're not going to pay tax when the money goes into investments. You're not going to pay tax on the earnings as it's earning. But then once you actually make a withdrawal out of that account, you're going to pay tax on all of it. Okay. So you're deferring that tax down the road. You're kicking the bucket down the road. The Roth, on the other hand, is the exact opposite. So the Roth is saying, if I earned $100 today, I'm going to put it into that Roth and it's going to grow. But separately, I'm going to pay tax on that $100 out of my paycheck. But the whole $100 goes in, and then it's going to grow tax-free, and then it actually comes out tax-free. So you get to take advantage of the compounding on your money to come out tax-free. So again, the Roth is the exact opposite of the IRA. So Social Security, we talked about tax-wise, may or may not be taxed, depending on your provisional income. A brokerage account doesn't get talked about too much. So a brokerage account uses capital gains. And so short-term capital gains is if you've held an investment less than 12 months, and then long-term capital gains if you've held that investment over 12 months. So a brokerage account can be a very useful tool. So if you're maxing out, say, your 401k at work and you still want to save more, you can still save, use the same investments. But it's another bucket that has just a little bit different twist on the taxation. So if you just have a regular brokerage account or you have a trust account, that's the type of account that it'd be sitting in, and it would be running on capital gains as the tax. Okay. Last but not least, I'll mention HSAs, so health savings accounts. So I'm a big fan of health savings account. If you don't know what they are, they're actually a triple tax advantage vehicle. So you're not going to pay tax on the money that goes into it. You're not going to pay tax on the growth, and you're not going to pay tax when that money comes out, as long as you use that money for healthcare related expenses in retirement. Does anyone plan on having healthcare related expenses in retirement? Right. So this is a fantastic vehicle to use. And one lesser known thing about it is if you're saving that money and it's going into a balance, a lot of times if you get a sizable enough balance for whatever custodian you're using, you can actually push that money through to a brokerage side where you can actually invest it. So a lot of times an HSA is sitting in a bank, but that bank money can actually be pushed through to a window to where you can actually use 401k type options and you can invest that money. So a lot of people will look at the HSA knowing that they didn't pay any tax on that money and then use it more like a flex spending account. Well, I think that the best use of that is to actually push that money into the investment side and then save that money for the next 10, 15, 20 years because it can grow and compound. And remember, triple tax advantaged is that money is going to come out tax-free. So if you have the means, use the HSA to actually be a savings vehicle and grow and invest it, not just put the money in and then use it in that same year. Okay. So again, big fan of that. Will my taxes go down in retirement? So this is a very common question I get. And it depends, on your personal situation. Do you have other taxable income like a pension plan in retirement? Because that's definitely going to throw off what your total tax bill is. If the majority of your savings is in one of those deferred accounts, so if it's in a 401k or IRAs, then you're going to have probably a higher tax liability than if that money was in, say, a Roth. And then what are going to be the impact of RMDs? So has anyone heard required minimum distributions? Right, so we're going to talk about those next. Required minimum distributions. So using this chart based on your date of birth is the age that you have to start withdrawing money out of a tax-deferred account, okay? Notice I said have to start withdrawing. So there's no more option. What most people didn't realize is the whole time they were deferring money into that IRA is they had a silent business partner, and his name's Uncle Sam. And so for all this time where they were allowing you to defer and defer and defer, now they want their tax dollars. And so they put together the RMD table to forcibly make you take money, make withdrawals out of your account so that you can pay tax, okay? And so first is the age that you have to start making those withdrawals on the previous table. And then next is that you have to use this table in order to figure out how much of your RMD is due for that given year. So what happens is at the end of the year, you have your 1231 balance and use that 1231 balance, and then you go down in this table, say age 75 is an RMD factor of 24.6, so that you run the math out and that comes to a 4.065% withdrawal. So in that year of that person being 75, they have to take 4+% out of their IRA, mandatory, okay? And what's the penalty for not taking that 4% out? The penalty is 50%. So half of what you should have taken out is now the penalty for not taking your RMD. So it's a pretty big deal to make sure you do this. So the other thing I'll point out on this table is if age 75 is 4.06%, age 76 is 4.2%. So as you can see, every year that you get older, that percent that you must withdraw gets bigger. So this starts to become kind of a runaway train because they're wanting to force you to basically withdraw down to get their tax dollars. So every year you get older, you're taking more and more money out, even if you don't need that. Now, if you do need the money, that's perfectly fine and the RMDs aren't going to hurt you. But if you're in a case where you've saved enough and you don't actually need those savings and it's in a tax-deferred vehicle, they're going to force you to take that out, and it's going to force you into a tax bracket that you might not want to be in retirement. Okay. All right, so this I'm going to talk about. I think it's not talked about enough, but we'll call it the widow's tax. Is a lot of times when I'm sitting down with families, I'm doing planning, married filing jointly couple. And if you've noticed on almost every chart that I've put up here, there's a married filing and then there's a single. And those tax rates and the clawbacks and all those things have been different. So if you look at those charts, the rates have been different on almost everything that I've showed you. So in this case, if we do a bunch of planning for married filing jointly and then one person were to pass away sooner than anticipated, the remaining spouse is automatically thrusted into the single filers, which is not as friendly of a tax code, okay? So going through my example here, if I've got a married filing jointly couple and they're bringing in $60,000 in Social Security, and then they're taking IRA distributions of $70,000 for a total income of $130,000. Right now, an estimate of $12,000 is due for federal tax. Okay, so just using this as an example, and their net income would be around $117,000. So if one of them were to pass away, we'll just say Social Security gets cut in half, but they want to maintain that same lifestyle. So maybe they're helping the grandchildren with dance lessons and still wanting to travel, and they just don't want their income to go down, even though it's only one spouse. So they're going to up the distribution out of their tax-deferred accounts, out of their IRA. So we're going to come up with the same total income of $130,000. But if you look at that tax, the tax is almost doubled, right? So by going from the married filing jointly more friendly into the single filers, we now have a completely different situation from a tax perspective for that remaining spouse, okay? Net income then is down because the taxation was so high. So this is something I like to run through, and there's ways to run scenarios to look at different options of, making sure that a remaining spouse is taken care of. And then this also just emphasizes the need to do some tax planning and look at things like, our Roth conversions and getting out from underneath the IRA or the tax deferred, something that you should plan for. Okay. Taxes in retirement. Who thinks they're going down? Anyone think taxes are going down? No. Anyone think that taxes are going to stay the same through your retirement? Maybe. I personally believe that taxes are going to be going up. So the next few slides are going to be a little bit sobering when it comes to total tax in our federal government. So we'll roll through that. All right, this is America's federal marginal tax rate. And you can see by this chart that we're actually at a low point. So in history, the marginal tax rate was much, much higher. So going back to 1945, when World War II ends, the highest marginal was 94% of what you earned. So you made enough money to where every dollar you earned, 94% went to tax after a certain threshold. Okay, that's a pretty high tax bracket. When Reagan became president, 69.13 was the highest in 1981. Okay. So overall, the marginal rate is lower than it has been in the past. Now, don't get me wrong, there's a lot of other taxes that have been added into, okay? So the federal may be low compared to history, but we're getting hit with a lot of other taxes that weren't around, say, 20, 30 years ago. Next, we're going to look at the federal budget, which this is very eye-opening. So this comes from the Congressional Budget Office, and this information is from March 20th of this year, 2025. So when it comes to the income for the federal government, total revenue was $4.9 trillion, okay? And in mandatory spending, we had $4.1 trillion. So think mandatory spending, Social Security, Medicare, Medicaid, military, just everything essential in order to run our government. So you add on the net interest was $0.9 trillion. So you basically get to $5 trillion of non-discretionary spending. That's a lot of money when we brought in $4.9 trillion in revenue. And then we have this extra line item called discretionary spending. So what's discretionary spending? Well, that's our elected officials getting together and passing laws and spending money. And you can see that totaled $1.8 trillion. So in 2024, we brought in $4.9 trillion, but we spent $6.8 trillion. So how long would your household last if that was your budget? Not very long, right? Okay, so we have a little bit of a spending problem. Some legislative risks to look out for in retirement. So they can change deductions. So through your lifetime, I'm sure you've seen the deductions change multiple times. So that can change at any time and be more or less favorable for you. Tax bracket changes. We've seen those quite a few times. We just recently got a tax bracket put into place that they said, quote unquote, is permanent, which means it's permanent until they change it. So now, at least for the next 5 years, we've got what we think is the tax brackets we're going to run under, but they can always change these and take our marginal brackets back up to more historical norms, which would be much, much higher than they are today. Social Security taxability. So remember 0%, 50%, 85% graph? Well, they could change those numbers. That could be 100% on the top end, and they could be totally taxing 100% of Social Security for those that have high provisional incomes, okay? Step up in basis and capital gains. So this is one I like to spend a little bit of time on. So remember that brokerage account or the trust account gets taxed on capital gains. Capital gains right now is somewhere between 15 to 20% depending on your income. But what is it charged on? So the example that I like to use is an old farmer. So you got Farmer Joe that way back in the day bought a whole bunch of land for $500 an acre, right? And now that same land's worth $10,000 an acre. So if he sold, he would be taxed on the difference between the $10,000 he sold it for and the $5,000 he bought it for. So that's a lot of tax. So if Farmer Joe doesn't sell that land and he passes it on to his children, and the day after he dies, they turn around and sell it for $10,001, how much tax are they paying? Or what are they paying tax on? They're paying tax on $1. So obviously our elected officials know this. There's a lot of not only land, but think of your house if it's paid off, any collectibles, brokerage accounts. There's a tremendous amount of money that's out there under long-term capital gains that people are just waiting to essentially pass away, and then their heirs are going to get a step up in basis and avoid a tremendous amount of taxation. So we've already seen legislation introduced to go after unrealized capital gains. So they're going to go after Farmer Joe and say, we want to tax you because we know you bought it for this and now it's worth that, but he hasn't even sold it, but they're trying to get after that money because there's a lot out there. So think commercial real estate, personal real estate. There's a lot of money out there that they could go after by changing the law on how things are taxed from a step up in basis perspective, okay? And they've tried already. Last but not least, in 2025, we did get the One Big Beautiful Bill. So what that did was it made, again, quote unquote, permanent current tax policy. So the 2017 Tax Cuts and Jobs Act was expiring. They needed to put something forth so that we knew what we were going to run on in 2026. Is at the end of 2025, the the TCJA 2017 was going to sunset, is what they call it. So we needed something done, and then they did get it done. So now we're under the One Big Beautiful Bill, and hopefully then that will stay in place for at least the next 4 or 5 years, but we'll see what happens in the future. All right. So next we're going to go through a quick case study of Rob and Rita. So these are actual people. $60,000 in Social Security. They've got $160,000 in total brokerage. They had $420,000 in Roth savings. They were a big advocate of the Roth and started saving in that early. And then they had $1.4 million in total tax deferred. Okay. So when we ran them through the program and started looking at what their tax liability was going to be, the first year that their RMD was due was going to be age 73. And that RMD alone was going to be $116,000 of taxable income to them. Okay. So they did a really good job saving. They don't actually need that full withdrawal, but based on the math, they're going to have a very sizable RMD that's going to be due in year one. Okay. And then remember that factor is going to move, and that percentage they're going to have to withdraw is going to get even bigger over time. So looking at the proposed strategy versus their current trajectory, on the right side here, you can see the current trajectory where that graph just goes up. So in their lifetime, they were going to take a total of $6.4 million in RMDs. Okay. And this is a projection running out into their age 90. And at the time we ran this, they were age 62. Okay. So we're extrapolating over time. If you don't need that money for retirement, but it's tax deferred and you're going to have an RMD, when are those RMDs going to start? And then as you can see, it just keeps escalating on how much they have to withdraw. Okay. Over here is our proposed strategy where we took that $6.4 million down to $113,000 in RMDs because we were effectively moving money out of the tax deferred portion so that they didn't have an RMD. And then the scale on this is off a little bit. But basically by the time they were 75, they were done with RMDs, whereas they just started them at 73. So we put together a plan to effectively get them out from underneath the RMD trap. This is the same scenario on the federal tax paid. So over on the right side, with those RMDs, they were going to pay about $2.8 million in just federal tax for those RMDs that were going to come off of that account. When we did our maneuver, they paid higher tax for a little while, but then you can see it fell off a cliff because they basically ran down those tax deferred amounts and got out from underneath the RMDs, so they weren't forced to take distributions when they didn't want to. And so then you can see by, I think around age 78, they're the lowest tax bracket they've ever been in. Okay. So with some planning here, you can adjust what that future tax bracket is going to be by paying attention to what bucket are your dollars in. And so if you have a lot of tax deferred money, that's going to keep you in a higher tax bracket much longer than probably what you'd like. Okay. All right. So the Social Security Administration says, this slide is my chance to poke a little bit of fun here. But I, first of all, want to congratulate you for taking the time to educate yourself today. So the Social Security Administration says there is no one best age. It is your choice. So essentially they're putting it square on your shoulders to figure out what's the best age to take Social Security and how do I make all this work the best for me. Okay. So they say you should make an informed decision. Individual and family circumstances are different, right? And then my favorite line is, we hope the following information. So you got the federal government hoping for you, hoping that you make the right decision. Okay. So a little bit about the administration is really good at answering specific questions. So as you go through your journey, if you have, timing questions or dollar amounts or want to verify work history or things like that, they're very good at answering questions. But if you call them trying to ask, is it better if I take it at 62 or if I wait till 64, what's better? They're not really going to answer those questions. So it's going to be more on the administrative side of what they're going to help you with. Okay. So otherwise it's up to you to help inform yourself and then run some calculations and figure out what's best for your situation. So in closing, did we learn something new today? Hopefully. Good. Why am I just now learning about this? So don't feel alone or like you're on an island because you don't know a lot of this information. I believe that there's a big deficit in the amount of time that our education system spends on learning finance and Social Security and investments. And that's not a shot at any educator. It's just the fact that the system is not really built to inform us of all this stuff as we go through the school system. But you're here now, so congratulations again on getting educated, but don't feel like you're behind. And then, are you confident in the financial plan that you have right now? So hopefully I introduced some new information that's got you thinking about things in a little bit different light based on taxation and income, because Social Security is just one aspect, so it's really hard to answer that question of what's the best age to take it, because I believe that looking at the whole picture is what would serve you and your family best over the long term. And with that, that's the close of the presentation. I'll hang around for some questions if you'd like to ask, but thank you for attending. I really appreciate it. Hey folks, thanks for watching our 3-part series on Social Security, income, and taxation in retirement. We know that was a lot of information, and some of it may be new to you, but just like our presentation, we won't leave you hanging. As my thank you for attending, I'd like to offer you the opportunity to speak with me personally to answer any of your questions or to get started on creating your personal retirement plan. There is no cost or obligation. I'm willing to put in the work to get you started. My offer includes 2 free reports just like the ones you saw in the presentation. If you'd like to take advantage of this offer, please use the link to schedule a 15-minute call to get started. I look forward to helping you.